So why invest in multifamily, right? People have been buying multifamily properties for 1,000 years. There's documented evidence of multifamilies in the 11th century AD. And you might say, wait a minute, didn't you just tell us all the great reasons to buy multifamily, all those great trends? Yes, but every trend I told you about has only existed for the last 15 years or less. But people have been buying this for 1,000 years, and there's very common sense fundamental reasons like cash flow, right? If it doesn't cash flow, don't buy it. You've got to be able to cover all the cost of operations and external management, all of your utilities, all of your maintenance, capital improvements, basically so you can keep improving the property and replacing the equipment, and your mortgage. After that, it should still make cash flow. If it's not doing it, you're not buying the right thing. While the exact return will depend, double-digit returns are very common in the multifamily industry. So above 10% is very common on an annualized basis. The second reason is forced appreciation. Do you remember about 30 minutes ago, I told you this is the most important slide in the presentation? Remember the one where if you raise your rents by $25 on a 250-unit property, the value goes up by 800,000, maybe even $1.5 million? That's what forced appreciation means. Multifamily values are based on net income that they produce. Now, doubling the profit can double the value of the property. Now, technically, it doesn't happen, but the value does go up a great deal, right? And even with stabilized properties, I'm not just talking about properties that are empty. Even with stabilizing property, you can optimize the management, you can reduce expenses, and that can yield big returns. Here's an example. So toilets, you can spend, you go into an old property and you see these toilets that have 5-gallon flush tanks. Well, you replace them with new ones that have 1.28-gallon flush tanks, and it costs you somewhere around $200, $250 to do that, depending upon the area. Now, the return on that, though, is absolutely staggering, because over the next 3 years, every dollar that you invested, the $250 plus installation costs to install it, has already been recovered after 3 years. So first, now in the fourth and the fifth year, you're going to make all of the gains from that water saving. But here's the cool thing. On a 250-unit property, you can save about $30,000 to $40,000 a year by doing this, assuming all of them were 5-gallon flush tanks. $40,000 a year. Now, again, do that multiply by 15 times if it's 6.5 cap. Now that's $600,000 that is created by just replacing toilets. This is a fully occupied property. You're not rehabbing it. You're just optimizing it. There's so many optimizations like that. Old boilers use so much more energy. You can come in, replace a boiler. You can capture your capex over the next 3 or 4 years, but then when you're selling, again, you get that 15x multiple for that new income. So there's so many different ways of creating money in multifamily. Here's my favorite: professional management and metrics. I've been a chief operations officer of a company that had 350 employees. You cannot run a professional organization without metrics. You've got to have specific metrics, sales metrics, cost metrics, profit metrics, and you've got to be able to talk to your property manager about these metrics every week of the year. There is no single family owner anywhere in the United States that has ever done this on a weekly basis. But multifamily managers talk to their property managers each week in scheduled calls. I hold these calls every single day at 9 o'clock in the morning with different properties. And that gives me the ability to really optimize or tweak the performance of a property over time. So I love the metrics-driven approach that you can take in multifamily. Inflation protection, right? So, and this one applies for all real estate. People have invested in real estate because the world banks are going crazy. We've printed $4 trillion, $4,000 billion since 2008, just in the US alone. Worldwide, we're up to about $12 trillion that have been printed. This is liquidity that was only created because of all the problems in 2008, but the liquidity still exists. None of it has been withdrawn from the market, and as a result, it's warping things, and it could cause high inflation or hyperinflation in the long run. It's also about the debt. America is now creating $1 trillion of debt That's $1,000 billion of debt in just 7 months. Every 7 months, we create a new trillion. Well, back in the 80s, it was taking us more than a decade to create $1 trillion of debt. So as we accelerate this cycle, everyone on the phone knows it has to end at some point with hyperinflation. So it's very important to have real assets which have fixed value, not just real estate, but gold, timber, things that don't lose value during hyperinflation are tremendous inflation protection. And anybody that's looking at our federal deficit should be looking at this. Tax benefits. Both single family and multifamily benefit from something known as depreciation, which is a way to push back your taxes. But with multifamily, it becomes even better. In a multifamily property, thanks to Mr. Trump's new tax laws, I can depreciate a huge amount of money in the first year, which means that you might receive a very highly negative K1 in the first year for your property. Typically, even if you're investing $100,000 and I'm giving you $8,000 a year, in most cases, your K1 is going to be negative. It is not going to show $8,000 because even though that's what's going into your bank, it's going to be negative. The first thing that we do at a property is we do something known as accelerated depreciation or cost segregation. This allows a third-party company to come in and say stuff like, well, we're supposed to depreciate everything over 27 years, but take a look at this boiler. It only has 6 months of life left. Let's depreciate it over 6 months. And what about that computer? I think that computer only has 2 years of life left. Let's depreciate that over 2 years. By accelerating the depreciation, we front load the returns for our investors and allow them to have negative income for the purposes of taxes while having positive incomes in their wallets. And then economies of scale, another one that I absolutely love. Think about this. What if you had 250 single-family properties spread all over the San Francisco Bay Area, right? You don't get that economy of scale. You don't have the benefits that we have in a multifamily that's 250 units where there's a centralized shop, there's full-time employees that do maintenance. Not contractors, not somebody you're paying $40 an hour to. If a pipe breaks, your staff fixes it. If you have a light going out, your staff fixes it. They're constantly up and about fixing stuff, doing 20, 30, 40 trouble tickets a day. That efficiency is huge. They don't go to Home Depot 3 times a day. They go to Home Depot once a week and they bring stock in and they keep it locked up and then they keep using it as they go, right? Also rehab. Think about it this way. You have a single family property, one property, and you have a tenant in there. Your occupancy is 100%. What if that tenant leaves? Your occupancy now is 0%. But in multifamily, on a 250 unit property, if 10 units are empty, you're at an awesome occupancy of 96%. And those 10 units that are empty, you can rehab them and you don't have to worry about the fact that you're not getting rent. Because 96 is considered an awesome number in multifamily, and you still have 10 units to rehab that your staff, the people that work at the property 9 to 5 every day, they can rehab them. And with multifamily, we don't rehab them like single families. We spend $5,500 to $6,000, rip out the carpet, replace it with laminate. We just redo the countertops, we'll put in new appliances. It's all cosmetic. It's cosmetic rehab, and it makes it turnkey. It makes it it have economies of scale because you're just doing the same replacement unit to unit to unit. You're not doing new things. And it makes it so much faster that you can rehab units within a week, sometimes as little as 3 days.